Right. Okay, so we're going to move on to one last part in page 372 about ethics. Now it says your firm is the auditor to Dollar Bank, and a competitor to Dollar Bank is Frank Bank has invited your firm to accept appointment as auditor. Now explain what's the ethical issue we have in the case, and whether or not your firm is allowed to accept appointment, and what procedure that you must undertake to safeguard your track. Now, so what's the issue that we are having right now is you are currently auditing Dollar Bank, and now there's another bank come and approach you and say, can you do audit for me as well? Because you're not, okay? Now, so in this case, what we can understand is the ethical issue is what we call as a conflict of interest. Okay, so what is a conflict of interest? Now, that's a situation that you are not able to safeguard the interest of a person. It's called a conflict of interest. Now, but when you say conflict of interest, then you have to identify whose interest is that. So in this case, the interest will be the interest of Dollar Bank as well as Frank Bank. So there's two banks over here. So it's conflict of interest between two different clients of our firm. Okay, it's the interest of Dollar Bank and interest of Frank Bank. Okay, now, so the concern that we have here is what? Now, concern is about duty of confidence, whether secrets would be leaked from one to another. Okay, now that's the main issue that we are having. Okay, so that's the ethical issue. So is this issue allowed in the ACCA rule book? The answer is yes. Okay, so there's no issue to stop us from acting for two clients that they have conflict of interest, no problem. But obviously you need to do something to safeguard the track. So the problem that we are having is what? Secret might leak out from one to another. So that's why the whole idea of how to protect this is to build some sort like a wall to prevent information flow from each other. Now we call that safeguard as a Chinese wall procedure. Okay, the safeguard, it's a Chinese wall procedure. So basically is to build a wall so that the people who is auditing Dollar Bank and Frank Bank, they will not be able to transfer information to each other. So what kind of things that we expect them to do? Now, basically, number one, you have to use different teams to audit Dollar Bank and Frank Bank. Okay, you use different teams to audit Dollar Bank and Frank Bank. Okay, so by separating the people, you taken away the risk of the same guy having access to both information, and you also need to give very clear instruction to these people over here that they cannot exchange information. So you must give very clear direction about issue of confidentiality. Okay. Now, giving direction we find is not enough. You've got to be strict enough that you must get them to sign an agreement that they're aware of the issue, that they will not leak out the secret. That in the event if they leak out the secret, what will happen? What action can you take? Now, normally we get the staff to sign what we call as a confidentiality agreement, and you have to play a part to secure their information. So you must implement internal control, for example, like password, access control to your data file, okay, so that you will not allow unauthorized users to have access to this data or record. Okay, now if it's necessary, we will advise our client to seek additional independent advice. So if this is not giving them enough confidence, we just tell them that if there's anything you worry, then you can always go outside, get another expert and advise you. But that's not the case for audit. Okay. All right. Now this is the last part on ethics, which is to do with conflict of interest. Now can we move on to the next page? Okay. See point 11. If we're going to move on and look at the audit process. So what happens when you're going to accept an audit and how you're going to start an audit? Now basically the process must be like this. See, we begin off with acceptance. Okay, so the starting point is you must first accept a client. Now, that's what we do in chapter 3, all right, accepting a client. Now, the moment you've accepted a client, then you've got to do the audit work. But audit work will always begin off with paperwork. So that's where audit planning comes in. And once you finish all your planning issue, then you will perform your audit work. So we're going to see a whole issue about acceptance planning. Okay. Now when we look at acceptance, now the first thing that we need to see about acceptance is this. Now as auditor, you need to know that before we accept an audit appointment, okay, before you accept an audit appointment, usually what do you need to do? What factors must you consider? Now, so we're looking at factors. Okay, the factors are quite straightforward. As a mnemonic, I put it as RICE. Okay, it's easier for us to remember. Okay, we put it as RICE. Okay, so what is RICE again? Now, before you take up a client, you ask yourself these 4 issues. Now, RI is issue concerning the client. CE will be issue concerning you. Alright? So you ask yourself these 4 things. Okay, the first one is we ask about risk. Okay, R is about risk. Now, do you think that accepting the client, the risk is acceptable to you? Alright? So is the engagement risk acceptable to auditor? Like for example, can they pay you after you finish all the work? Do you think that there's any potential litigation? Like we do not want to do an audit that later we will end up being sued by another person. So you must evaluate the risk. Okay, so if it's just an ordinary statutory audit, that they just do audit because they need to file their accounts, they need an auditor's report, usually the risk is not very high. Okay, it's just a normal audit. Okay, now look at the risk. Okay, I is to assess integrity. Now that the client, that the management has a high level of integrity. So do you feel that these people here are honest? Okay, do you think that they are honest or not honest? Now, see, integrity is very, very important in your audit engagement, because if you have clients that they are not honest, you're going to get problems like fraud. Okay, so some problems with client with poor integrity, for example, like fraud. Okay, now for example, they will conceal information. They purposely don't give information to you. Alright, they hide it from you. These are all problems to do with clients that they're not very honest. Now you see, these two factors, you look at it from their point of view. Okay, you assess them from client point of view. Now the other two factors, we look at it from our point of view. So we are looking at competency, whether we have the experience, whether we have the knowledge, whether we have the skill, whether we have resources, the people. Now all these are the things that you must ask before you take up the audit. So you believe that you are able to handle the job. Okay, you don't take up an audit that at the end you can't handle the job. Okay, so that's why you must look at your competency, which obviously include capability. Then you must look at ethics, that there is no significant threat. If yes, then what safeguards that you're able to implement so that you can reduce the threat. Okay? Now, so seriously, when you gonna take up an audit, if there's a new client to you, then what must you do over here? Okay, so before you can accept. So that's why we are looking at some procedures that you got to do. Okay, now so I just elaborate over here. Now usually what we do is, when you have a new client, we need to perform a professional inquiry. Now, or alternatively, you can also call this as professional clearance. Okay? So you need to do this thing called professional inquiry or professional clearance. Now, the whole idea of professional inquiry is you need to go and ask their ex-auditor. Okay, so assuming that before you take up the audit, they already have an auditor, so you must go and ask their auditor that is it okay for us to take up the job. Now, if you ask the auditor and the auditor say no because there's some problem, then you better don't take. But if you go and ask from their auditor and the auditor say no issue, everything okay, normal, then you take. So the whole idea of doing this professional inquiry is to create a way that we can assess integrity, because the ex-auditor can tell us, they can warn us in case if there's a problem. Okay, now so in the notes there's a diagram that will tell you the whole process. You can go back and read back on that part. Okay, now besides doing the professional inquiry, you also need to establish what we call as the precondition of the audit. Okay, you have to establish preconditions of the audit. Now, what do you mean by precondition of the audit? Now, see, when we say precondition of the audit, the word precondition of the audit, okay, now I got no space, so I just go down and write here, okay. Now, what do you mean by precondition? So we're referring to some basic requirement that you must have it before we agree to start the work. Okay, so there's the basic things that we need to have it before we agree to start the work. So this is called precondition. Now, so exactly what are the preconditions that we see here? Now, the precondition include, number one, that client uses an appropriate financial reporting framework. Okay? Client uses appropriate financial reporting framework. The framework refers to the accounting standard. Okay, let's say, for example, you go and ask the client, you say, hey, what standard that you use when you prepare the account? So the client said, okay, we apply IFRS. Then you check, do you think that IFRS is appropriate for their case? If you think yes, okay, then that's one of the precondition. Okay. Now, the second precondition is you must get them to agree to the basis of the audit. So you must get the board management to agree to the basis of the audit. Now, we call this as the premise of the audit. Okay, so the basis of how audit will be conducted. Okay, all right. Now, what's the premise or the basis of the audit? Okay, number one, the basis that we will take up this audit is on condition that you must confirm your responsibility to prepare financial statement. Okay, so that they confirm their responsibility to prepare financial statement. Okay, so you will have to tell us that it's your responsibility. So you must confirm that first. So okay or not? Okay. Number two, you also need to confirm that it's your responsibility to internal control. So you cannot come and tell us at the end that these two things, I don't know, it's not my responsibility. You can't, because before we take up the audit, you will have to agree that these are your responsibility. Now, that is our condition. Before we accept, you must confirm. Okay. Plus, number three, you also need to agree that you will give the auditor access to information. So you cannot come and tell us that this one you cannot see, that one you cannot see. You must agree that we are given access to information. Now, that you will give auditor whatever information requested by auditor, and you will give auditor access to people within the entity. Now, we call these as the precondition. So before you take up the audit, what you get to do is you must establish that all these conditions are fulfilled. Now, if all the things are there, and if you're happy, then fine, you can take up the job. Alright? Now, usually when you want to take up a job, you will need to formalize it. So that's where you need to use an agreement. then we sign black and white. Now, so I'm going back to point 12. Okay. Now, going back to point 12. Okay. What is the purpose of engagement letter? Now, actually, what do we expect to see inside an engagement letter? Right. Now, if you look at purpose first of all, now actually, engagement letter is a contract. Okay, engagement letter is a contract. So what is the purpose of having an engagement letter? What's the purpose of having a contract? The contract is to indicate there's agreement to the term. Okay, a contract is to indicate that you agree the term. So you sign the contract. Okay, and the agreement of term is important to prevent misunderstanding. So that later you don't come and tell us or you don't agree with this because you already signed. It's all black and white. Okay, so it's to prevent misunderstanding, and obviously is to prevent argument. Okay, it's to prevent argument. Now, argument. Now it's the engagement letter that we use it to establish precondition of the audit. Now, why do we say so? Because the three things that just now we listed down at the bottom, that you confirm your responsibility to reporting, to control, that you will agree to give us access. Now, all those things will all be included in the engagement letter, and then you got to sign. So the moment you sign and say you confirm means you already indicate to us that the conditions are there. Okay. Now then, number 4. That this purpose of engagement letter is also used as a form of safeguard. Okay, that is to safeguard the independence of the auditor when we define properly what are the scope, what are the responsibilities. So what are the things that we do, what are the things that you do. So all these things will be spelled out very clearly in the engagement letter. Now, so you can see that engagement letter, a sample is given in page 37. Okay, you can just refer to my notes in page 37. Then you'll be able to see a sample. Alright? Now, if you take a quick look of the engagement letter, alright, let's turn to page 37 of the notes. Okay, quickly. Now you see the engagement letter is meant to state out clearly all the terms of the audit. Alright, so usually we start the engagement by telling them what engagement is this and what is the purpose. Now that's why we mentioned over here that you have asked us to do audit of financial statement, and then we list down what's in the financial statement, and then we tell very clearly that our objective is to express opinion. Now, to make sure that you later do not misunderstand what we do, we clearly put down the responsibilities of auditor. So we tell them that when we do audit, we will follow the international standards on auditing. Okay? Now, we will only get reasonable assurance that financial statements are free from material misstatement. So we do not guarantee you. That's why I tell you it's reasonable. Okay? Now then we tell them the way how audit is performed, that we will perform procedure to get evidence regarding amount, disclosure, and all these procedure that we do will depends on our judgment and assessment of risk. So that's what we're going to do later. So that's why there'll be a risk assessment. And on top of evaluating amount disclosure, you will expect that we will also evaluate your accounting policy. We will also look at your accounting estimates and your presentation. Now, we will always give a disclaimer and tell them that there's always inherent limitation in audit. That's why there's an unavoidable risk that material misstatement may not be detected. Now, in order for us to do risk assessment, we further and tell them what we're going to do is we will evaluate your internal control. So after we evaluate control, then we know whether your control is good or not good. But we will not tell your shareholder. That's why we say the evaluation of control is only for risk assessment, not for purpose of expressing opinion on its effectiveness. Now, but towards the end, all these weaknesses that we believe you should know, we will communicate them to you. That means we'll inform you. Now, then this is the part that the premise comes in, that we want the directors to agree all these things to us towards the end. Okay, then we will also ask them to give representation. Now, then the rest of it, you can include like how you charge the fee, how you express your opinion and issue the report. Now, then at the end, you get them to agree. Now, overall, the report, the engagement letter will have something like that. Okay, now, so we're going to see a very small issue that can test on what we just covered there. Now, look at point 13 over here. Now, we say that responsibilities of an external auditor are not always well understood. So when external auditors provide non-audit services to the audit client, it's essential that auditors make clear distinction between audit and non-audit responsibilities. So explain exactly what are the responsibilities of an external auditor to the director and to the shareholder. Okay, what responsibilities that we have to the directors and to the shareholder. Now, do we have any responsibilities to directors and shareholder? Are they the same? Obviously, they are not the same, right? The shareholders are the owner, correct or not? So what's our responsibilities that we discharge to the owner? Now, overall, you know the objective here is to do an audit and express opinion. So our responsibility is to express an opinion regarding the truth and fairness of the financial statement. Okay? Now, that's what we're supposed to do, right? So our objective is to express opinion. Okay, if you want to give an opinion that about the true and fair view of financial statement, this opinion carries an assurance, right? So what assurance is that? It's a reasonable assurance opinion. Okay, so we're going to give shareholder reasonable assurance. Alright, we're going to give shareholder reasonable assurance. Okay, and how do you give shareholder reasonable assurance? That means it's our responsibilities that when we do the audit, we must obtain sufficient, appropriate audit evidence. So this is why when you do the audit, you must look into how much evidence you need, as well as the quality of evidence that you collected. So you must look into that. That's because we have a duty to serve the shareholder, okay? And not only about the evidence, it's also about how they can feel confident in us. So that's where we look into issues of independence. So that's why we must also observe our ethical value. So we must remain ethical. Now that's my responsibilities as auditor to the shareholder. Okay, so because of audit and because I'm serving the shareholder, I will have to make sure that all these things will happen. Okay? Now, but we do not take instruction from the shareholder because audit is statutory requirement. So everything is fixed according to the framework. You don't have to tell us what to do. We know exactly what to do. Now, but do we have responsibilities to the director then? Now, honestly, we don't have responsibilities to director because we are not accountable to directors. Yes or not? So if you look at it, external auditor is not accountable to directors. So really, there's very minimal responsibility. Okay, it's very minimal responsibilities that we see over here. Okay. Now, but then, we do have one responsibility that's meant for directors in specific, which is communicating to directors of whatever key issue. Okay? So it's not just that at the end that we report to shareholder. There are certain things that when we go through in the audit, we find that because it's important and shareholders and directors need to know, so we're going to tell them. The example like what? Now just now if you see the engagement letter, we say that we will tell you significant deficiencies in the control. So when it comes to weaknesses in the control, we will inform you. So that's why things like, for instance, fraud, internal control weaknesses, then it's our responsibilities to inform the directors. Now, so if you really look at it, it's quite different. Okay, so our responsibilities to auditors and shareholders are quite different. Follow? Now, all that will come from understanding engagement. So if you look at the terms, you'll be able to see the difference. Okay. Now, so that's chapter 3. That's chapter 3. Okay. Now we move on to the next area. We're going to see audit planning now. So assuming that you've accepted the audit, okay, you've accepted the audit, you've signed the engagement letter, okay, you get them to sign. Now you're going to start the work. So you're going to start planning. Now actually what is planning? Now if you look at definition given in the standard, planning is actually involving two things that we're going to do. Now planning, it's a process where auditor will establish audit strategy. Okay, audit strategy. And we're going to use that audit strategy to develop an audit plan. Now, what's the main difference between the strategy and audit plan? Now, strategy is overview. It's not detailed. Okay? It's going to give you a big picture. So if overall you want to know what audit is going to be, you read the strategy, you see the big picture. Alright? But when you want to look into the detail, for example, like when you start auditing fixed asset, what are you going to do? When you start auditing receivable, what are you going to do? Okay, then you must go to the plan. So the plan is meant to be detailed. Okay, that's why audit plan will tell us nature, timing, extent of your procedure. APM, audit procedure. So you can't come up with an audit plan until you have your strategy. Okay? And the main thing you're going to do in strategy will include risk assessment. Now that's why when we learn chapter 7, we talk about nature, timing, and extent of your TOC and your SP. Now all those things that we discussed, when you put them down, you're going to put them inside your audit plan. But that are those things that you can only come to it after you finish off your assessment. So that's how the things go in a logical sequence. Okay, so from here come to here. Now, so why must we plan the audit? Now, this is a very popular requirement that they like to ask. Okay, why do you plan the audit? So what's the benefit of planning? Now, if you refer to the note, you can see quite a long list. I just tell you where of the notes are. Okay. Now, in page 41, okay. Now, these are all the reading points, so I don't want to go through and waste time here. So you just go back, you run through. Okay. So after you read, you cover the notes. Half an hour later, you come and fill in the blanks. And then you can test whether you remember or not. Okay, so there's quite a number of reasons why we plan. Use that, go through, then come back, fill in the blank. Alright, now, so we're going to move on and look at this thing now. You see, the first thing that we need to do is to come up with this audit strategy document. Okay, now, so audit strategy is a document, okay? And inside this document, they will have 4 main sections. Okay? They will have 4 main sections. So you just imagine that we divide them into 4 areas, okay? Now, and every area in the strategy, they're serving a purpose. So there's a reason why we need one particular section, okay? Now, so what we're going to do is to list down the section. So you know what are the sections. Then you know what are the purpose, and you must also know example of what will go into this section, so that when you really come up with a strategy, you're going to fill in the detail. The detail will be example. Okay. Now, so the sections that we're going to see as a mnemonic, I put it as CTAR. Okay, CTAR. Okay, what's CTAR? Now, C refers to the characteristics of engagement. T for the timetable. Okay, the timetable is just a short form that I use. It's actually about timing, nature, forms of communication. Okay, A, it's the audit approach. Okay, A is the audit approach. So A will be the direction of the audit. So at the end, how you're going to do the audit, you just look at the approach. Okay. Now then, the last one, the R refers to resources. Okay. Now, every section is meant to give us an overview. Okay. So the purpose of all this section is going to give us an overview about something. Okay. Now, what overview that we need to see from each of these sections? Characteristics will give us an overview of the client. Okay. So this is the part that you will get the background information about the client. Okay, so everything that concerns the client is here. Now, including things like what? Okay, here's an example. For instance, like what kind of business that they do, what kind of financial reporting framework that they use. What are the location of all their business entity? What group structure that they are having, so that we know how that account should be consolidated. What kind of reporting currency that they will use in the financial statement. So we need to do translation of currency. Now these are all examples of things fall under characteristics. That's why you can see it's all about client. It's nothing about you, right? It's nothing about the audit. It's all about the client. So anything that is about client, you must put here. So when you open up the strategy and you read, that's the first thing you're going to see. You see things about client. Okay, now then what is this timetable? Now the timetable will give us an overview of the audit timetable as well as deadlines. Now because whatever we do in audit, this is a statutory requirement. So you need to know that there's certain deadlines we got to follow. Like how many months that from the year-end company will need to file their account. So you don't have your own sweet time. So that's why these are all the things that you must know. So for example, what you must determine is like, what is the year-end? Okay, what's the year-end? Okay. You must ask when do they intend to authorize financial statement, and when will they issue financial statement. Okay, it's very important so that we know the deadlines. Alright, now besides the deadlines for reporting, you also need to specify deadlines that we will need to communicate with different parties, like who and what. Okay, who and what, that is very important. Okay, so you want to call for a meeting. Okay, who do you want to call for a meeting? See, like for example, you're going to call for a meeting with the board of director, okay, now why? Maybe you want to discuss the audit approach. Now you want to have meeting with management. So that you can discuss about deliverables. Like when will they pass all the records to you, vouchers to you, when will things be ready. Now these are examples of things you're going to do. So it's about having meetings with people, when you're going to meet them, how you're going to meet them, what do you want from them. Now it's all here in timetable. Okay, now in terms of the audit approach. Now audit approach basically would be the important factors that affect the audit. It is the focus. Okay, it's how we're going to do the audit. Now this include setting materiality of the audit, identify which area in financial statement with high risk of MM, descriptions of their internal control, identify significant risks of the audit, and the quality control policy. Okay, so that's on the audit approach over here. Now finally, in terms of resources, now the whole idea of resources is actually about manpower budget. So seriously, there's nothing much to give an example. That's why I say give example for all except this, because this is the area that we determine who to do what and how much time to spend. So that's on the manpower budget. Okay. Now, so you recall and remember that when you prepare your audit strategy that time, okay, so when you prepare audit strategy, now these are the issue over here. You must have 4 sections. Now in the 4 sections, they cover different things. So what matters do you need to put inside? Now these are example of the matters. Okay, now that's called a strategy. So examiner can ask you to prepare strategy. Examiner also I can ask you to explain what's the strategy. You just refer back to this. Okay. Now so we look at this part. Okay. Now referring to the audit strategy above. Now do you realize that without knowing or understanding your client, it's not possible for you to produce a strategy? Agree or not? Now you see all these things that we write down over here, we really can't fill in anything over here, okay, until you know who is your client. So that's why we are talking about knowing your client. So you need to understand your client. Okay, so what we have in the auditing standard is ISA 315 identify 6 different areas that you need to understand about your client. Now every different area also they are relevant for certain thing in the audit. So what is it that you want to know and why do you want to know? Okay, we discuss it over here. Okay, now so as a mnemonic again, okay, you can recall Green AP Cross IC. Okay, so these are the 6 areas. Now if you want to know example of the area, examples of what goes into all these, you just refer to my notes. Okay, just go back and see the notes. So here I just want to focus on the knowledge of what do you want to know and why do you want to know. Now so I'll divide it into 2 parts. Okay. Now, see, REI, it's about the regulatory framework. E is external. I will be industry factor. Now, so again, why is all these things relevant to the audit? Now, we can give a lot of examples. See, like when you look at the regulatory requirement, you're able to determine what kind of reporting framework that is suitable to the client. So you're able to assess their framework, okay? So regulatory. Now, when you look at their industry, you might be able to determine What are the key industry factors that can give rise to risk, so that you become more focused. Okay, now to give an example, let's say if you audit a client that involved with technology business. Okay, if you audit a client to do with technology business, then you realize they might spend a lot on R&D, research and development, and R&D will involve a lot of accounting estimates, like how you're going to recognize them. So all these will add some complexity to the audit. So that's why if you look at this industry, you know there's something you have to watch out. So that's why we want to understand their REI for that reason. Okay. Now number 2. Now we look at the nature of the entity. Now when you say nature of the entity, now nature refers to what? Now nature may include like what business that you do, operation, what ownership, what kind of financing, what kind of investment that you plan to make. These are all about your nature. So nature is about your operation, the way you run the business, who are your owners, how do you get your finance. This is all about nature. So in which way that nature become relevant to audit? Okay, example, if you look at the nature, you can then know what kind of expected account balances or class of transaction. What is expected in the account? For example, if I tell you a business, do you expect to see a lot of inventory? Do you expect to see a lot of cash? Or do you expect to see a lot of receivable? So you must have an expectation. So when you look at the nature, then you know what to expect. Then when you know what to expect, you look at the account, then you know whether the accounts appear normal or not. Okay? Now, knowing their ownership, for example, can help us to identify who are their related parties. Okay. Okay, A for accounting policy. AP, accounting policy. Now we need to look at accounting policy because we must look at assess consistency of their policy with the past. We must assess appropriateness of the accounting policy that they have used. So that's why we must know what policies that they're using. So this is the reason why policy is important. Okay, P stands for their performance measure. Okay, the performance measure will tell us what is important. You only measure something that you find it important. So the measure will tell us what is important. So you look at the performance measure. So from the measure, we know which area that management takes them seriously, because these are their performance indicator. So it could be a potential risk of misstatement, could be risk of manipulation. So that's P. Now we have ROS, So risk, ROS is risk, objective, strategy. Now, see, objective is what they want. So to get what they want, they come up with strategy. And to come up with strategy, they will face the risk. The risk will give rise to financial impact. Okay? So that's why we believe that if you are able to understand objective and strategy, then it will be easier for us to identify the risk. So it will be easier for us to assess the risk. So it will be easier to assess the risk when you know all these things. See, like for example, your strategy. Now you start to give a lot of credit. The risk is bad debt. So when you audit receivable, you must ask yourself, do you think that allowance is necessary? Okay? If they're irrecoverable debts and they don't allow, then chances is you're going to suffer. So this is what we're going to see here. So that's your ROS. Now then we look at internal control. Now the reason why internal controls are important is because internal control directly affects your control risk. Okay, and because internal control directly affects control risk, so you must assess your control. See whether the control is good or not, then only you can determine what level of risk that they're having. Okay, now so that's the 5 things. Now in the notes there's a lot of examples. Okay, you must go back and go through again what's in the notes. Okay, so overall that's the 5 things and some of the reason why we need to know them for purpose of the audit. Okay, all right, now turn to the next page. Okay, now you see, when we look back into the audit strategy just now, the most important in the audit strategy is the direction. Okay, the audit approach. Alright, audit approach. Because that's the part that affects us the most. That we have a lot of things that we must consider. So now let's say we want you to prepare an audit strategy. Okay, let's say I ask you, I want you to prepare an audit strategy for ABC Limited. So what do you expect to do inside the audit strategy? Now you're gonna have all the 5 things over here that you will have to write something that will indicate your application. Okay, that include example that we say you need to set materiality. Now you're going to see in the audit strategy part, for example, you're going to write something like this, that you will say the financial statement materiality is, I just put 200,000. The set based on 5% of the PBT, performance materiality is 150. Now, so something like that will appear in your audit strategy because you have to give numbers so that the auditors look at the strategy will know what materiality that you're using. Okay, so when you want to assess the risk, that which area with higher risk of material misstatement, then what do you do? Then you will apply things that we call analytical procedure. So what you do here is you apply analytical procedure. So you're going to write something that relates back to AP. For example, you're going to say that the gross profit margin was 30% in 2012 and 38% in 2013, which is an unexpected increase. Okay, so you don't feel that the margin should go from 30 to 38, let's say. So after that, you identify what risk you have, then you probably will conclude that there will be a higher risk of maybe sales becoming overstated. So this kind of thing will also come inside as part of your audit strategy. Okay. Now then you also need to write something about the internal control. What do you think about the internal control? So you're going to talk about the component. For example, you can mention about their control environment. That's where you're going to assess the control. That's where you're going to use your ICQ, ICQ. From there you see and you write down what do you think. Okay. For instance, you're going to say that ABC has weak control environment. The board has poor commitment to competent blah blah blah. So something that you want to highlight so that the auditor will know what do you think about the internal controls. You write about the internal control. Now, do you think that other than that, is there any significant matters that will affect the audit? So we call significant matters as what? As significant risks. So significant matters or significant risks in which way? Okay, for example, you can say that there is a material litigation where ABC is named as defendant for a case blah 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 that they sue for $5 million. So that is something that you believe the most important significant issue in the whole audit. Okay, that is a very major thing that you must focus. Now then finally, you need to bring in issue about quality control. Now the main thing about quality control is like, for example, direction issue, supervision review. Now you have EQCR as well. You can put in things, for example, that the engagement quality control reviewer appointed for the audit of ABC is another partner called Mr. Johnson, something like that. Okay. Now, so this is about writing down a strategy. So other than just telling me what is in the strategy, probably examiner will say, okay, I want you to come up with a strategy. So to come up with a strategy, how do you apply? Now, I'm just giving you an example of how do you apply. Okay, that's the example. Okay. Now, so I'm going to move in and look back into all these things one by one because these are very important issues. Okay. So the first thing that I'm going to cover with you here is issues on materiality. Okay. Now, what is materiality again? Now, we use it to measure how significant something is. Okay, so basically when we say material, mean this is something very important, something very significant. It's called material. Because you know, material is important, is significant. So how does the standard define material? Now the standard define material by saying that something is material when its omission or misstatement would influence economic decision of the user of the financial statement. That's what they mention here about what is material. And obviously, to know whether something will influence economic decision of the user, the standards say that materiality is a matter of what? Professional judgment. You will have to exercise judgment. Okay? And we normally look at materiality from two ways. Quantitatively, that means you express them in amount. And you also look at materiality qualitatively. That means although it may not be related in amount, or probably the amount is small, but it can still be very important because of the nature. So these are how we look at materiality. Okay? Now, so when you do the audit, you've got to set materiality. So, and this setting of materiality is what you do at the beginning when you start the planning. So what do you do? Now, then you must understand what are the different types of materiality. Now, we divide materiality into two. So during your audit planning, auditor shall establish materiality level. Okay, so this is what you're going to do. You need to establish materiality level. So how do you establish materiality level? Now remember, there are two levels. Now the first level is what we call as financial statement materiality. Like an example, like you take 5% times profit before tax. Okay, let's say you get the amount as 100,000. Okay, once you get this, then you must get the other one. That we call it as performance materiality. Now, how do you get performance materiality? For example, you take financial statement materiality and you reduce it. Maybe I can reduce it by going for the third 2/3/4 of it. So in that case, from 100,000, the figure become 75,000. So what is performance materiality? Now we say it's a materiality level that is lower than financial statement materiality. So it will always be lesser. So whatever you see on top, you just go to reduce it. That's what you do, just reduce it once more. Now why do you want to have another materiality that you reduce it? The purpose is to reduce to an acceptably low level the risk of undetected plus the uncorrected misstatement exceed financial statement materiality. Because when we do audit, we don't audit everything. We actually take samples. Okay, so when we do audit, we actually take samples. Now when you take samples, there's always another part that you didn't audit that you wouldn't know. whether inside there's problem or not. Okay, so imagine like if I have a financial statement, let's say my materiality is 100,000. So in my financial statement, if I take a sample and I audit, now let's say after I audited, I detected misstatement that is, let's say, 80,000. Now if the 80,000, they decided not to correct all the mistakes, so they only corrected 10,000, now that left with 70,000 become uncorrected. Now obviously if the 70,000, you compare the 100,000 that we have here, there's still no problem because 70 is still less than the 100. Now if you look at just these two figures, of course there's no problem. But what we concern is, what if in the financial statement I have another misstatement that is undetected, that the amount is 40. So this is the issues that we have here. So what if we have another portion of misstatement which is not detected? So in that case, if you want to reduce this kind of problem, then the way we do it is, instead of using 100,000 as materiality, you reduce it. So imagine from 100,000, I reduce it to 60,000. So once I reduce to 60,000, then they say I want to correct my mistake to 70. I say I won't allow because I only accept anything below 60. So from 80, I will ask them to correct all the way until, let's say, 50. Now 50 plus another 40 add up is still below the 100. So this is what we are looking at. So we cannot eliminate the risk, but we are just trying to minimize the risk. Okay, so that's why we do it in that way. We just reduce it one portion. Okay, now, so when you set materiality, as you see here, what we do is we take percentage times something. So that is what we call as a benchmark. Now usually the benchmark that we choose for all the profit-based entity is like we take 5% of PBT. Okay, usually for those profit-based entity, we take PBT. So PBT is a very commonly used benchmark. Now, why use profit? Because profit is the main reason that affects decision of all the shareholder and investor. Now, but sometimes you may get cases of company with losses or they have no profit. Sometimes you get things like charity, that they do not focus in making profit. Now you may even have small company that being small company mostly are owner managed, that the owner don't care about profit on the financial report one, and most of the time they distort the profit, they don't have to pay taxes. So because of all these reasons, these are those situations that profit figure could be unusually low, that you shouldn't use profit as a benchmark. Now then you can consider to use turnover. As a benchmark. Okay. Now, so this is what you're going to do. So far, if you look at planning purpose, that's it. You just want to come up with a figure, so that you got a figure for purpose of your audit. Now, why do we need to set this materiality over here? What's the main purpose? Now actually for us to set materiality, the reason is number one, to reach conclusion. Okay, so the purpose is to reach a conclusion. Now, if you do not know what is material, you cannot tell whether a financial statement is materially misstated. So that's why we must have something to measure. So if you know that 50,000 is material, then 40,000 is not misstated, is not materially misstated. So that's why we need this for conclusion purpose. Now, number two is actually for us to design nature, timing, extent of your audit procedure. Now the way we look at this, the correlation of materiality with how to design procedure example, we know that if your materiality level is set as low, then the amount of audit evidence we need is high. And if you set a higher level of materiality, you basically reduces the amount of evidence. So there's a relationship. Okay? So because the moment you tolerate less error, there's low materiality, then to get confident that there will be less error, you have to do more work. So that's how the two things correspond. Okay? Now, number 3, to assess risk. Okay? To determine the focus. Because when we look at the audit, we can know that anything that is more material, they are more important, they are obviously riskier. So this is what we're going to do here. Okay, so we want to focus. Now that's the main purpose of why we set materiality. Okay, now, so that's on materiality. Okay, just turn to the back. Now, besides materiality, another issue which is very, very important in F8 is risk. Okay, now take a look at risk over here. Now you see, the reason why we learn about risk is because everything we do in audit is called risk-based. So we apply audit risk model to do a risk-based approach. Now what do you mean by doing a risk-based audit? Now doing a risk-based audit means we actually design audit procedure based on the risk that we assess. Now how do you design your audit procedure based on the risk that you assess? Now we look at the model first. Now first of all, the model is like this. Now AR stands for audit risk. Now audit risk is actually made up of the risk of material misstatement that we divide them into inherent control. Okay? And detection risk that we divide them into sampling risk, non-sampling risk. Now, this audit risk is what we want. We want it low. Example, 5%. Okay? So, audit risk is the objective that we want. We want it low, we want it 5%. Now, when it comes to the risk of material misstatement, now this is the risk that financial statement will be materially misstated before we do the audit. That means the risk that the accounts got mistake. So the risk that the account got mistake is something that related to the client that we cannot control on. Okay, auditor cannot control. So what auditor will do is auditor will assess, i.e. auditor will quantify. Okay, we're going to assess, we're going to quantify. Now, the moment you quantify your IR and CR, then you realize that DR must be a balancing figure. And then we will use the DR level to determine the work that we need to do. Okay, we're going to use the DR level to determine the work that we need to do. Now, so a simple example is like, we tell you, if my IR is 100, CR is 80, then DR is what? So you just work backwards and you will get a balancing figure. Now when you get a balancing figure, 0.05 divide 1 times 0.8, now you're going to get 6.25%. Likewise, if I want to use 5%, instead of 180, what if I have 80 and 50? Then again, what will my DR be? So 0.05 divide 0.8 times 0.5, then we get 12.5%. Now, so you can see that in these two cases, different risks that we assess will give rise to different level of detection risk. So when I have a lower DR, so what do I need to do? When I get a higher DR, what do I need to do? So this is how you design the audit. Then you must ask yourself, what are the situations that can make DR low? What are the situations that can make DR high? So if you know the situation, then you know what to do to control the DR. So that's how risk-based audit comes in, okay? Now, so that's why we must understand the meaning of all these risks. Okay, so we start on the definition. Now, we look at audit risk as risk of giving an inappropriate opinion. Okay? So when you give an inappropriate opinion, you measure that as audit risk. That audit risk depends on the risk of MM and DR. Now, then we have IR, CR, and DR. What is IR, CR, and DR? Now, IR is the risk of MM occurs in financial statement, assuming when there is no relevant internal control. So you assume that if there's no internal control, then things become naturally there. What's the chance that misstatement will occur? Okay, so the risk that misstatements occur naturally is called inherent risk. So that's why inherent risk will depend on the business environment that you're in, who are the people, all these things. So we have factors that we call it unique and clean. Okay, now then on control risk. Now what's control risk then? Control risk measure the risk of internal control not preventing, detecting, or correcting MM in the financial statement in a timely fashion. That means the risk that internal control will fail, that internal control will not do a good job. Now, so the factors will depend on the 5 components of internal control itself. So if the 5 components are good, then obviously control risk will reduce. If they're not good, then control risk will go up. Okay. Now then finally, detection risk is what? Risk that we will not detect material misstatement. This is called detection risk. So this is the risk of audit procedure will not detect material misstatement in the financial statement. And what affects detection risk is basically NTE of the audit procedure. So it's the amount of work that we do. For example, that's why we say, if you want to reduce your detection risk, then what do? You must do more audit procedure. For example, perform more substantive procedure. Then you reduce detection risk. Now, if you think that you can accept a higher detection risk, meaning what do? That means you can have less audit procedure. So if you reduce your substantive procedure, then your detection risk will go up. Okay? Right, so these are the first part. I think we take a short break, okay? Take a short break, come back, then we continue.